Most people tend to think of banks as being exposed to traditional financial risks, things like credit risk, market risk, and liquidity risk. But what a lot of people still underestimate is just how deeply climate change is now beginning to affect those very same risk categories. This isn't about a sustainability report or an ESG marketing campaign. It's about the fact that climate change has become a very real financial risk, one that's already showing up inside banks' balance sheets across retail lending, corporate portfolios, investment books, and treasury activities. So let's take a step back and look at this in a very practical way. First, climate risk affects banks through what's known as physical risk. These are the direct impacts of climate events: floods, wildfires, hurricanes, or prolonged periods of drought. Now imagine for a moment that a bank holds a mortgage portfolio in which 20% of the properties are located in regions that are now classified as high flood risk. If those homes are badly damaged by extreme weather and lose value, borrowers may no longer be able to repay their mortgages even if they want to. Now that leads to higher defaults and higher loan loss provisions. We're not talking about a theoretical scenario. This is already being seen in practice. NatWest and Lloyds, for example, have both begun mapping their mortgage portfolios to flood risk data from the UK Environment Agency. And during the ECB's 2022 climate stress test, some banks had to assume that heat waves and floods would cause losses equivalent to 70 or 80 basis points of capital over just 3 years in their mortgage portfolios. But climate risk also shows up through something called transition risk, which is very different. Transition risk isn't about weather events. It's about what happens when governments, consumers, or technology suddenly move away from high carbon industries. A coal-fired power plant might look profitable today, but what happens if a strict carbon pricing policy comes in, or if customer demand collapses because renewable alternatives become cheaper? Suddenly that business model becomes unviable. Now, for a bank that's lent money to that company, the credit risk increases sharply. That's why ING has already started reducing its exposure to thermal coal, and why Danske Bank has exited the coal sector altogether. Now, those decisions aren't just about reputation. They are based on a financial assessment that the long-term credit fundamentals of those companies are deteriorating. Now, this isn't limited to one part of a bank. In retail banking, physical climate risk can have a direct impact on mortgage portfolios. In places like California or parts of Australia, banks are increasingly concerned about wildfire and flood risk, not for environmental reasons, but because it directly affects the repayment capacity of their customers. In corporate lending, transition risk is front and centre. Banks dealing with corporates in sectors like oil and gas, heavy industry, shipping, or aviation now have to assess not just whether those clients are profitable today, but whether they have credible transition plans for the next 10 years. In investment banking, climate change can affect the market value of assets and the demand for capital markets products. For example, the trading value of bonds issued by carbon-heavy companies has already come under pressure in certain markets because investors are pricing in future regulation. And even in treasury portfolios, climate risk is now being considered within sovereign bond investments. Countries that face high physical risk and have limited capacity to invest in adaptation may face rating downgrades over time, which directly affects the risk-return profile of bonds held by the bank. Now, all of this is why regulators are taking the issue extremely seriously. In 2022, the European Central Bank ran its first continent-wide climate stress test across more than 100 major institutions. Banks were asked to model two specific scenarios. The first was a disorderly transition in which policy action is delayed and then suddenly introduced, causing abrupt changes in carbon prices. The second was a hothouse world scenario in which very little action is taken and global temperatures rise by more than 3 degrees Celsius, leading to widespread physical damage. In the disorderly transition scenario, the average bank saw a reduction of 7 to 13% in lending to high emission sectors, simply because those sectors were no longer financially viable. In the hothouse scenario, physical losses were more than 4 times the baseline. And importantly, those tests were not one-offs. Climate scenarios are now being integrated directly into the standard supervisory toolkit, which means the outputs may eventually influence capital requirements in exactly the same way credit or liquidity stress tests do today. The interesting thing is that the leading banks are not waiting for regulators. They are taking action themselves. Several banks are now developing geospatial tools that combine physical climate data with internal loan data. Rabobank, for example, now overlays its agricultural loan portfolio with maps showing drought and flood patterns so that they can identify where repayment risks might increase in the future. Other banks such as Santander have begun to incorporate transition risk scores directly into the credit approval process. In practice, this means that if a company applying for a loan has no credible decarbonisation plan and operates in a high emission sector, the bank may price the loan higher or simply say no. Similar changes are happening in Treasury. Some Scandinavian banks have started to limit exposure to sovereign bonds issued by countries that have a very high physical climate risk score and limited ability to adapt. And on the strategic side, banks like BNP Paribas have published specific climate-aligned targets for sectors such as oil and gas and linked those directly to business unit performance targets internally. It's also important to take a balanced view. Yes, climate change creates significant risks, but it also creates opportunities. The transition to a low-carbon economy will require massive investment in areas like wind, hydrogen, energy storage, and low-carbon infrastructure. Banks that adapt early are not just reducing risk, they are positioning themselves to finance some of the fastest growing parts of the global economy. In fact, several international banks reported last year that revenue from arranging green and sustainability-linked finance already outstripped revenue from traditional fossil fuel-related lending. The key takeaway is this: climate risk is no longer a separate external issue. It's becoming part of everyday financial risk management. Any bank that treats it as CSR or marketing is going to be caught off guard when those risks start showing up in default rates, bond valuations, or capital requirements. So the real question is not whether banks should care about climate risk. The real question is how quickly they can incorporate it into the same risk frameworks they already use for credit, market, and liquidity. And that leads to a final reflection worth considering. If the current pathway for global temperatures turns out to be correct, which one do you think will impact your own organisation more? The physical risks from extreme weather or the transition risks from rapid policy change? And more importantly, are you prepared for both? If you found this video helpful, don't forget to like, subscribe, and hit that bell icon for more videos just like this one. If you're keen to learn more about finance, be sure to check out theindustryportal.com, link in the description below. Thanks so much for stopping by, and as always, keep growing, keep learning, and I'll see you in the next video.